the markets have always posed an enduring riddle to those who dare to enter them. Why is it that a small percentage of individuals seem to achieve extraordinary, consistent success while the vast majority, often armed with intelligence and relentless effort, end up on the losing side? It is a question that has baffled generations of traders and investors. They observe the markets moving with a chaotic, unpredictable rhythm, believing that luck or secret knowledge must be the key to unlocking its fortunes. This pervasive belief, however, is a dangerous myth. It masks the real truth that the markets are not just governed by economics and statistics, but are a raw reflection of human psychology. This fundamental misunderstanding is precisely what keeps so many from ever realizing their potential. They look for external answers when the real key lies in an internal, disciplined approach. The search for a magic formula is a path to ruin. The path to wealth lies in understanding unchanging human nature. Jesse Livermore, the legendary boy plunger of Wall Street, stands as one of the most compelling figures in this riddle. His career was a tumultuous saga of immense triumphs and catastrophic losses, a journey that made him a profound student of market dynamics and, more importantly, of himself. He didn't just study charts and prices, he dissected the very nature of speculation, uncovering timeless principles forged in the crucible of his own experiences. Livermore's rules weren't theories born in a classroom, they were hard-won conclusions paid for with vast sums of money. The fact that he lost fortunes on multiple occasions before rebuilding them to even greater heights makes his wisdom particularly invaluable. His legacy is not just a collection of successful trades, but a timeless blueprint for psychological and strategic mastery that, a century later, remains the most potent guide to navigating the markets. He discovered that the most powerful force in the market wasn't a stock's potential, but a person's discipline. Rule number 1. The rule of patience and observation. His first and perhaps most counterintuitive rule was this: the big money is not in the buying or selling, but in the waiting. This simple phrase challenges the very core of what most people believe about trading. They are conditioned to think that constant activity, a perpetual state of buying and selling, is the key to profitability. Livermore knew this to be a fallacy. He understood that the vast majority of losses come from impulsive decisions driven by a need for constant action. He believed that the trader's greatest skill was not in being fast, but in being still. He taught that it was crucial to wait for the market to clearly show its hand, to reveal its true direction before committing capital. He wasn't interested in guessing the next move, he was interested in confirming it. The danger of this impatience is profound. It leads to overtrading, a financial hemorrhage that bleeds a trader's account dry through commissions and a series of small, emotional losses. The fear of missing out, or FOMO, is a psychological trap that compels traders to jump into a position prematurely, often just as the trend is reaching its peak. Livermore saw this as a weakness of character, not a lack of strategy. He understood that the market has a way of punishing those who act out of emotional haste. He believed that this incessant need for action was an expensive vice, a form of gambling that confused motion with progress. The most profitable moments, he realized, were often the long stretches of time when he did nothing at all. His emphasis on sitting was not a call to passivity, but a mandate for active observation. Livermore spent his time studying the market's behavior, looking for undeniable patterns and confirmations, not for hunches or tips. He believed that when the market offered no clear signals, no decisive trend, the smartest move was to do absolutely nothing and preserve his capital. He saw capital as his army, and he wasn't going to send it into battle without a clear strategic advantage. He recognized that the most important thing for a trader is to be in a position to take advantage of a great opportunity when it finally presents itself. If you've exhausted your capital on a series of small, impatient trades, you'll have nothing left when the true opportunity arrives. Rule number 2. The rule of following the trend. Livermore's second rule was a direct consequence of his patient observation. All great money is made in the big swings. This principle meant he never tried to predict the exact tops or bottoms of a market. He knew that was a fool's game. Instead, he would wait until a trend was clearly established and then enter the trade, riding the wave for as long as it lasted. This approach fundamentally contradicted the popular, but often ruinous, advice of buying low and selling high. The market has no obligation to conform to your desires of when it should bottom out. Attempting to catch a falling stock is like trying to catch a falling knife, a move that more often than not results in serious injury. His wisdom here was about acknowledging reality over hope. He understood that a stock that is making new lows is weak for a reason, and a stock that is making new highs is strong for a reason. Instead of fighting the market, he learned to align with its powerful, self-sustaining momentum. By riding the trend, he captured the most significant and profitable movements, where the real fortunes were made. He would not enter a trade until the market provided him with unmistakable confirmation that a major move was underway. His goal was not to be a hero who bought at the absolute bottom, but a pragmatic trader who joined the prevailing flow, profiting from its immense power. He knew that the profits in a market move are in the middle, not at the impossible-to-predict beginning or end. Rule number 3. The rule of cutting losses. Perhaps the most critical rule for survival, and one he learned through his most devastating losses, was this: cut your losses quickly. Livermore believed that this was the most essential skill a trader could possess. A loss, he taught, is not a personal failure, but simply a part of the game that must be accepted. The greatest psychological challenge for any trader is admitting they were wrong, and the ego is the most common reason for holding on to a losing position in the stubborn hope that it will reverse. He saw this as a form of self-deception, a desperate clinging to hope when cold, hard facts dictated a decisive exit. The market, he said, has no room for hope, it only has room for discipline. The ego, in this game, is your greatest enemy. It is the voice that whispers to you to hold on just a little longer, to average down on a losing position, to prove that your initial judgment was correct. This psychological trap is what turns a small, manageable loss into a catastrophic one. Livermore's rule was a mandate to suppress that ego completely. He believed that the moment a trade moves against you by a predetermined amount, it is a clear sign that you were wrong, and you must exit without hesitation or regret. He saw this as an act of ruthless self-preservation, a non-negotiable principle for long-term survival. He often used a potent metaphor: your capital is your army. You cannot afford to allow one battle to turn into a complete rout that decimates your forces. Every loss must be controlled and kept small, so that you are always in a position to fight another day, to wait for the next great opportunity. This rule is not about being a perfect trader who never makes a mistake. It's about being a resilient trader who lives to trade again. The trader who survives is the one who has mastered the psychological fortitude required to accept a loss and move on without a shred of emotional baggage. Rule number 4. The rule of pyramiding. This is a rule that runs contrary to most conventional wisdom. Pyramid into strength, not weakness. Most people fall into the dangerous trap of averaging down, buying more of a stock as it falls in the misguided hope of lowering their average cost. This is a psychological crutch, a sign of a trader who is stubbornly clinging to a losing position. Livermore did the exact opposite. He would add to his winning positions as the market continued to confirm his initial judgment. He saw a strong, advancing trend as a sign that he was correct, and his strategy was to maximize his profits on those few trades where he was right. He understood that true strength in the market lies in riding established, confirmed trends. His method was to initiate a position, and if the market moved in his favor, he would add more to it, and then more again, as long as the trend remained intact. This disciplined approach allowed his profits to compound exponentially on his most successful trades. The psychological courage required to buy more of a stock that is already advancing is significant, as it goes against the ingrained fear of buying at a high price. But Livermore knew that the highest price could often be the best price if it was part of a powerful, sustained movement. Rule number 5. The rule of psychological control. Finally, and perhaps most importantly, Livermore understood that all of these rules were rendered useless without psychological control. He believed that the markets were merely a reflection of human emotions, and the only thing a trader could truly control was their own emotional state. His primary task, he felt, was to manage the twin demons of fear and greed. Greed pushes traders to buy at unsustainable highs and hold on for impossible returns, while fear causes them to sell great stocks far too early. He saw these emotions as the principal saboteurs of every trading career. His solution was to use a trading plan as a shield. He would meticulously study the market, form a plan based on his observations, and then follow it with absolute, unwavering discipline, regardless of the emotional turmoil of the moment. This plan, written down and adhered to, removed the decision-making process from the heat of the moment and placed it in the cold, rational light of preparation. He would simply execute the plan, as if he were a machine, turning a psychological weakness into a systemic strength. This ability to separate emotions from decisions is the ultimate hallmark of a true professional. The enduring legacy of Jesse Livermore's rules is a testament to their timelessness. They are still relevant today, not because the technology or the markets are the same, but because the human psychology that drives them has remained unchanged. Fear and greed are as potent today as they were a century ago. The challenge for any trader, then, is not to find a new, secret method, but to master these foundational principles. The big money will always be made by those who have the patience to wait, the discipline to follow a trend, the courage to cut a loss, the wisdom to pyramid into strength, and the unyielding control over their own emotions. The question remains, are you willing to accept the psychological price of true market success?